Okay, so today we're talking about guaranteed income, and we're using a system which involves three buckets of money. And we're breaking the $930,000 of IRA 401k money that Jake and Sally, who are our case study here, have acquired, and they have in their retirement, which is a lot of money, and it's a lot of money to them. But yet when they look at retiring, that doesn't seem like a lot of money. When you put the 4% rule on that or something, it's $35,000 or so of income, and that's not enough money to retire on. And then they're worried about the principal going down. They retire young. One of them lives into their 80s and 90s. Is that people worry about this stuff, and they don't know whether to start Social Security or not, how much to take out of the IRA. So this bucket strategy seems to work pretty well with. So let's just kind of jump right in and show what we're doing. So we're going to take $330,000 of the 930 of their IRA money, and we're going to distribute it to them. Or in other words, this certain period annuity in bucket number one, the balance starts at 330,000. At the end of 5 years, it's zero. And this thing is going to pay them exactly $6,000 a month. And it's going to start immediately in August of 2023. And it's going to be through paying them in July of 2028. So I want to bring Tom on, and he's just going to show you the show notes and go over a little bit of what we use to create bucket number one here.
Yeah, and so you can find these show notes in the link below of our video. They're also on our website. They're going to go into a little more detail than what we have on the board, so I encourage you to take a look. But like Hans said, the first one is really all three are going to be illustrations for these different products that we use in this situation. And so this first one is with Penn Mutual, and this is the product that we use, an annuity that we use specifically when we have a lot of clients wanting to delay Social Security, but don't really know how to create an income out of their investments, as well as they're worried about investment risk, as they've seen what happened in 2022. It's recovered some, which they're feeling better about, but they know it could happen again, and they don't want to start pulling out large chunks of money out of their investments if the market were to go down. So if what we have here is setting aside $330,000, you can see that here, into an IRA annuity with Penn Mutual, and what they guarantee is they will pay you $6,000 a month regardless of market performance, regardless of anything, for 5 years. And so in this scenario, we have the income starting in August of 2023, and it will last all the way until July of 2028. So you get 5 years of $6,000 a month, no matter what. One point I will make is that this was going to pay for 5 years, regardless of if both people are around. If one dies first, I mean, in this situation, there's a couple, pretty good chance they're both going to live that 5 year period. But if some accident were to happen, their beneficiaries will continue to get that payment for the remaining of that 5 years. So it's not like it's completely gone in that sense. And so this is bucket number one. This allows you to delay Social Security, get a paycheck, get an income coming in while you're doing so, and then and we'll talk about the benefits of delaying Social Security. I'll push that back to Hans here.
Okay, so why are we depleting 330,000 over 5 years and creating a $6,000 monthly income, $6,000 a month of income? It's because we really like these people delaying Social Security. They wanted to take the risk off the table. They wanted to get out of the market. They didn't want any uncertainty or a bad year or a bad run to affect their whole retirement plan. So this thing creates a check, and it starts $6,000 a month, comes in for 60 months, just like clockwork. And it also is going to get Jake, who's now 65, to 70. So he can delay his Social Security all the way to 70. And we're going to have Sally, who is the smaller Social Security check, take it early at 65. She's going to start at $1,500 a month right now. So take the 1,500 and the 6,000 and add it together. They got $7,500 a month, or 90 grand a year coming in. And we look just on average $6,000, $7,000, $8,000 of income taxes if they don't have really other money. Because these people in this example also have 200,000 on the side as money they haven't paid taxes on yet, part of their emergency fund, their savings account, that kind of thing. So they can add some income, buy some things, but this gives them 90 grand a year without really much of a tax bill. And they can supplement it if they need to out of the 200 grand. If they find they don't have to spend this much in a year, they can save a little bit. Now, this gets them 5 years out with only expending 330 grand. Okay, so the second bucket, we're going to put 300,000 in there. And what this does is we're going to start an income for both Jake and Sally in August of 2028, the month after this one stops. And that income is going to be $25.35 a month. So it certainly doesn't replace the whole $6,000 a month, but we don't need to replace it because Jake is going to apply for Social Security at 70, and their combined check is going to be $5,000 a month. That includes Sally's $1,500, and you add the $25.35 a month. You got $75.35 a month, and now it's for life. Both of these checks are guaranteed for life. Now, we do have a situation where one of them is probably going to die before the other one. And if the other one lives on, perhaps for a long time, they're going to live on with Jake's Social Security check. Sally's is going to stop. And then the $25.35 a month is just going to continue on, even if only one of them's alive. And even if the annuity is out of value, you still get a check every month as long as either one of them's alive. So this is a factor for life. I want to bring Tom on, and he can talk about the insurance product that we're using to guarantee this $25.35 a month for life.
Yeah, and then again, you can find the illustration, the full illustration, in the show notes. And so this particular one, bucket number 2, is with Midland National as the insurance company. This isn't the only one we sell for. There's lots of them out there, and so we'll price it out to make sure it's the best option for you. When you look at this. But like Hans said, this is a way, and this income is set to start right when the Penn Mutual one stops. And so they'll start Social Security. Jake will start Social Security. This income will start. So we sort of have a smooth transition, a little bit of a raise, but keeping $7,500 a month coming in guaranteed. One thing, and let me go to the next page. Again, there's more details we don't need to get into a lot on here. The main point we want to look at is the guaranteed incomes coming in. $30,000 a year, the $2,500 a month coming in, guaranteed for the life of both of them. So as long as either one of them is alive, that check is coming in. One of the pieces that's nice about this particular policy is it has what they call the LPA multiplier. Ultimately, what that would do is double that income if they were not able to perform 2 of the 6 activities of daily living. It helps cover some of that long-term care risk. It's not long-term care insurance, but it helps cover the cost of that. And so it goes from $30,000 to $60,000 of income coming in just right when you might need it because you're having to pay for care. So that's an added bonus. It's not the main reason in their case that we're looking at it, but it's nice to include. And again, that goes on for the rest of their life. Another point on this particular annuity is it has a cash balance remaining in there. And so if you have questions of how that works, you can call us. But if both of them were to die prematurely, there would be the remaining balance in this annuity is going to go to their beneficiary. So it's not money that you have left and is completely gone. If they both live into their 90s, pretty good chance there's no more remaining value in this annuity. But like Hans said, that income's going to come in even if it has a zero balance in the death benefit for the account balance there. So it's a nice way, again, to remove the market risk, have guarantees of income, create a paycheck that they can count on each month going on. And it's nice that it lasts for as long as either one of them are alive.
Well, yeah. And if either one of them were sick or would pass away before this start date of August 2020, that's just a point in time that we picked, we might do something different with this annuity, like delay it, accelerate it if they needed long-term care. And we would just make up the difference over here in this third annuity. So if they delayed this thing back here on the second one, they would get more than the 25, 35 a month for life. So there's a lot of options in these things. We just picked a point in time and showing you what's guaranteed. Now this third bucket, this is where we have the most flexibility. I mean, we have people that when we really do a thorough job and they're coming in to see us, and in this example that we're using, these people wanted to take the market risk, the investment risk off the table. They were done. And they just want to have their income guaranteed, and then part of their principal they just want intact and earning a good rate of interest. And so we just picked one of these from an A-rated company that is paying 5.3% interest. There's no fee on that. There's no nothing. That's the net rate that these people are going to receive and that you would receive. And it's a 5-year guaranteed annuity. So we could pretty much start one of these in August and put 300 grand in there. And at this date, when everything starts happening at the 5-year point, this guaranteed annuity is going to have 388 grand in it. We know that now. The interest rate's not going to go up and down, nothing. And then we could make withdrawals from this during the 5 years. We could put this half of it or all of it into something different. So this is really just an extra bucket to make up for things like inflation. We could put this thing or half of it into something like this and then let it grow for a couple of years, 3, 4, 5 years, and then start another income going. I mean, there's a lot of flexibility. And we also have some clients that really, they want to get out of the investment risk. They like all this guaranteed stuff, but they want to have part of their money invested in the market. They want to take some risk and they want to earn or try to earn better than a 5.3% return. And so we can take this piece, which is 300,000 in the beginning, and help them invest it and manage it and create an income that way. There's all kinds of flexibility with this, was really the point. And I want to bring Tom on to just show them specifically what we're talking about here with the MICA.
Yeah, and so this is the MICA is multi-year guaranteed annuity, very similar to a CD. You have a fixed number of years that pays a fixed interest rate. There's no what ifs, there's no unknowns. And so this particular one just happened to be with Athene. It was an A-rated company at the very good interest rate, so 5.3%. And like Hans said, at the end of the 5-year period, this account has grown to $388,000, and that's guaranteed. You know what that's going to be from day one. There is no uncertainty there. And so this bucket 3, there can be more flexibility here. Again, like Hans was saying, some clients are okay with some risk in the market. They don't want to get completely out of the investments because they want to have some upside. And when up years are there, they know they have their income taken care of, so they can afford to take a little bit of that risk. And so if you were comfortable with that, you could invest this bucket 3 in the market. In this case study, these people just didn't want anything to do with the markets. And so this is a way to get a decent rate of return as opposed to just putting it in the bank, earning, say 1%, 2%. We're getting 5.3% guaranteed. And again, it comes available. You can make distributions along the 5 years within reason. There's some rules around that, but after the 5 years, you have access to that money. You can do something with it. It helps lower the risk of inflation in the future. It gives you some flexibility. If you want to take some trips, you could pull it out of this money. I mean, just it's there, for sort of whatever you might need it for. And so in this case study, just to take a step back, we've put it into 3 buckets, each bucket doing something different, but really put together an income plan to show them how they can create an income, a paycheck for them into retirement without having to take really any market risk.
Yeah. And so don't get stuck on the exact numbers. If you have less than this, we can create something like this. And you may be a little older than this, and so your Social Security numbers may be different. You may be younger than this. So we can mess around with different numbers. May have more than this. And then you may like this piece and this piece. And so we've got to take $630,000 of your money to create this guaranteed income scenario. And then we've got all the more money that you have over here in this undefined piece that we can do a lot of things with. It doesn't have to go into annuities. It can go into investments of different kind, a life insurance over time. It can be a managed account. Um, the whole point of the concept is one annuity depleting over 5 years or 6 years or 7 years, creating a significant income with the delay of Social Security. And during that time, having a set of money that's creating a significant income on 2 lives that starts. And then once it starts, it continues for life. And then this third bucket that is over here to fill in the gaps. So now we want to talk about how does this fit within the context of financial planning, retirement planning, the 7 worries. I mean, we talked about Social Security. We talked about long-term care, how this middle annuity can provide some long-term care protection. And some people like to beef this one up because maybe they're uninsurable because of their health. They can't get a regular long-term care policy, but they put more money into this, focused on the one of the two of them that has some health problems, and they're going to plan to use this long-term care doubler piece. So that's awesome. And then the 401k IRA is that when people have retirement savings, that's where most of it is, and they haven't paid taxes on it yet. And so we've got to spread the distribution of this out over their lifetime for tax purposes. This whole thing is about income and really creating an income that you're not going to run out of money in your 80s and 90s. We talked about estate, is all 3 of these plans have a beneficiary on them or beneficiaries, and it's going to be the spouse first and then generally the children after that. So if people pass away early, there's going to be money coming out of the residual of these things. And then taxes, it's just very important that this gets spread out over a lifetime and not coming out in big chunks. So I want to bring Tom back on and see what Tom's final comments about this are.
Yeah, I mean, I think this is types of plans that we work a lot of times, and we put this together. Every plan looks a little bit different. Everyone's situation is different. Their income needs are different, and so again, the specific numbers aren't that important. But conceptually, this is a way to remove the risk, get income that you need, and just be not worried about what the market's doing moving forward into retirement. And so, if something like this is of our interest or a piece of it is of interest, give us a call. We're here to help.
I'm Hans Scheil, and we thank you very much for listening.
Thank you.